Good day, everyone. Welcome to the weekly note of GTC Traders. This is a feature we do each week, as you can tell if you click on the little category for the GTC weekly note. This is something that we do each week. If you are new, I am the senior partner of a separate private proprietary firm, and we decided, hey, how about we put our weekly note up? We're not by any means the only one that does a weekly note. This is something that's very common among many firms, weekly note or a daily note. And we thought, hey, how about we just make this real easy on ourselves? How about we just copy and paste sort of our weekly note from our private proprietary firm and put it over here on GTC Traders. So that is what we do. And the article itself has all of the vagaries usually of different thoughts as far as the economic calendar for that week and what we see in interest rates and various markets. If you're sort of curious about a weekly note, if you go to the GTC Traders YouTube page and you look at something like the playlists, so you click over at the playlists, come down here, go to the GTC weekly and daily note playlist, look at the full playlist. The first three, maybe even the first four videos really describe why so many firms do this. Okay, so why so many firms have a weekly and a daily note, really what is the value of a weekly and daily note, what it is and what it is not. So that's just for folks who are new. And then as I will now, I usually yabber on about the vagaries of each week. This is the weekly note for January the 8th, 2024. This week I wanted to delineate something. Each week on the daily note for the note portion, right? I always post the 3-month SOFR curve along with the Fed dot plots and the U.S. Treasury curve, right? The blue where we are now, and then a couple of other dates like, last FOMC, the lows, and then that sort of puts us in where we're at now. I'm not saying that I'm trading those. Like GTC Traders specifically focuses on equities, okay? For you folks who are new, that's stocks, right? Stocks, stock options, that sort of thing. So, but each week I include in the weekly note, where's the SOFR curve at? What have we seen along the SOFR curve? What have we seen all the way out to the 2028s, as we mentioned this particular week? What are we seeing in 4-week bill yields and 50? Well, why? Why do I put that information? It doesn't matter if you only trade equities and you don't trade the SOFR products, SOFR derivatives. It doesn't matter if you don't trade, the 2s and 10s. It really doesn't. If you trade in any serious way, you really have to understand what's going on with interest rates, because pretty much interest rates rule this world. And we have gotten a very severe lesson in that in the last year and a half. But this is something I've said going back to my previous public iteration, all the way back to 2008. Right back in 2000, back in the beginning of 2008, I'm almost screaming, right? Not literally, but figuratively screaming, like in my public entries. Are you guys watching what's going on with the Treasury curve? And I appeal to a lot of new traders, and they're like, we don't even know what that is. Point being is, regardless of what you trade, you have to understand what's going on with the various interest rate curves. These are not the only two curves. I also look at, and as ones will note, I also look at equity terms and volatility terms. But you have to know what's going on with interest rates just to have any sort of inkling as to what's going on in the world, really. At this moment, when I look over at the other monitor here, it looks like we're having a rally in price in treasuries. However, so we're up to like the high range. I'm looking at the bonds right now. Looks like we are in the high range of where we were Friday. So a little bit of a rally. I just don't think we are out of the woods yet when it comes to higher for longer and inflation. I've been evaluating this for some time. Ones have asked me for my thoughts on inflation. They generally like my sort of macroeconomic look, and I figure where's a better place to put that than the weekly note. Let me blow this image up right here. So again, looking at the U.S. Treasury curve, we see Well, basically from where we were at the end of November, we see lower yields, excuse me. So we had higher yields here. We had a lot, we've very obviously come down, right? Well, we've rebounded. So the red is November 24th. Then we have December the 27th. This was sort of a low that we put in for yields back here from the 5-year to the 30-year. Now we've come up just a little bit. I don't think we're out of the woods yet, both for inflation and higher for longer and with rates yet. And well, to do that, let me talk about inflation for just a bit. Ones who know me for some time will know what this is. It's sort of something I just use for a whiteboard. It's Dan's whiteboard. Just go into Paint, and that way I can just sort of illustrate things to a greater degree, right? So when we think about inflation, what do you think about? What's sort of the inputs on inflation? And far too many people say something very basic like, well, money supply. If there's too much money, then you're going to have inflation. Au contraire, mon frere, that's not true. I find it humorous that someone like Peter Schiff has gotten a little bit of airplay now that we've gotten inflation after and very high inflation after the 23 years that he's been wrong. And when that's been pointed out to him in the past, he says something very stupid like, well, I don't know when I'm going to be right. Well, you know what? When it comes to markets, the only thing that matters is when are you going to be right? Pretty much. So, and we had gotten it correct. People who remember my previous iteration remember that from like 2009 to like 2000, what was that? I sort of shut that all down. 2016, I said, nah, we're not going to have high inflation. And you couldn't see high inflation. So is money supply a part of the equation? Yes. So if you want to say one piece of it, yeah, it's going to be it's going to be money supply, but it's not just a simple matter of, well, they're printing money, right? Let me shrink this. There we go. Make it smaller. You want to think about it as money supply sort of in the hot economy, right? So that's one piece of it. One. So what do we mean the hot economy? Well, if the Fed is sort of in operations to produce a money supply to buy one very specific asset, like MBSs, right? So you can just say MBSs because they're in trouble and they are on the balance sheet of various companies, and they're gonna buy those, and so they're gonna print the money, buy the asset, and then I'm not going to go through the entire FOMC from 2013 to 2019. My point here being, however, is that's not really in the hot economy, is it? That's not money that you saw, right? There was MBSs, and it went right back to the Fed, and then it went right. So you can't really say that that's tied to inflation. And that's why I said for years, no, you're not going to see inflation. Everybody's like, oh, there's going to be hyperinflation. Money supply always produces hyperinflation. Always, always, always. Well, really? Really? Hello? This is what ones have pointed to for years. Japan, printed far, far, far more than the United States for decades and decades and decades, and couldn't beg, borrow, or steal inflation. They were praying for inflation. Well, it's come back in a way that people didn't expect, which is what usually happens. But all of the money printing that you saw in Japan, no inflation. So no, money supply is just not, won't automatically guarantee inflation. That's just wrong. Japan proves it, right? Now, when you put that in the hot economy, and I'm using a very old term there, yeah, you could start to see some inflation, but that's only one part of it. And so what do we mean by hot economy? I'm, again, borrowing a very old term there. We're talking about everyone just being handed money. Sound familiar? Right? You can start to see some inflation. And as a matter of fact, I said that is that if between monetary and fiscal policy, if ones were very serious about seeing inflation, because they wanted to get it above 2%, and they couldn't get to 2% inflation if they begged, borrowed, and stole from 2009 to 2013, I was like, well, if they were serious about it, they would simply do what President Bush did, and they would simply print money and give it to citizens. That's a way to get inflation, but it's only one way. And mind you, I'm simplifying this greatly, but the other factor you got to consider is how cheap is the money, because you could even do that. You could even, print money, give it to your citizens directly, as we saw a few years ago. And if interest rates are skyrocketed, and there's another equation here, and I'm going to print that up here real quickly. Here we go. Availability of goods. So, or your supply chain. That can actually not just be the supply chain. That can actually happen in a number of ways. But, if you have a great deal of goods and they're very readily accessible, and you print money and you give it directly to the consumer, right? And interest rates are sky high and there's no problems with the supply chain and everybody can get as many goods as they want, it's still going to be a little bit difficult to see inflation. The reason why we've seen inflation, and the reason why back in August, everybody that knows me knows Dan started screaming about inflation, even though he had been so quiet about it for so many years, is we got all three of these. We got money handed directly to consumers. We had record low interest rates, and they were kept there for far too long, as I stated. And then we had supply chain issues. That is your recipe for inflation. I've heard it put well this way. This is not me, by the way, but I've heard others say this. There we go. And if you're the person that said this, I apologize. I cannot recall the source. It's not a Dan thing, right? But inflation will always be too much cheap money chasing too few goods. It's fascinating to me back in the teens, right? 2012, 2013. Everybody's talking about, all this, money printing to basically do what I termed volatility intermediation, right? And it was only that for balance sheet intermediation, really. And that's going to lead to inflation. Just look at Zimbabwe. And they did never, ever pulled apart the historical details of Zimbabwe. They would just say, see, Zimbabwe printing money, and that's going to lead to inflation. There's a little bit more to it than that. You have too much cheap money chasing too few goods. And the problem during the teens was, goods were everywhere. Every variety, every thought, the technology was absolutely incredible, exploding to a greater degree. Supply chains were plentiful. My God, anything you wanted in any variety, just the explosion we've seen, not just in technology, but how to avail yourself of those goods and how easy it was to get them and how easy it was to get them cheap. Good luck trying to get inflation. And especially with, with that money not being given directly to citizens. You just weren't going to see it. Well, that all changed a few years ago. Why? Because we had that perfect storm, right? Money was being given directly to citizens by the fiscal side of the house. That money was exceedingly cheap as far as interest rates. And all of a sudden, right, it's toilet paper. It's the problem with toilet paper. Right? That's the simple way to remember it. You couldn't find toilet paper and everybody had just been handed money, so what's going to happen to the price of toilet paper? It's going to go sky high. Very, very basic market forces. So that's simply to review. Now, we've had some easing, not very obviously, on the supply chain issues. Money is no longer cheap. Money is no longer being given directly to citizens. There's I haven't even gotten into structural inflation here. See, I'm simplifying this greatly. We could also get into structural inflation. I'm not getting into wage price spirals. I'm sort of reviewing where we came from and just sort of the basic way we got the inflation we got to. But this sort of reviews that. There's also structural inflation, which I've had my eye on. But this one right here as well, there's also growing economy. It's a little more involved than this, okay? Hot economies. I will say on this one right here, although we did see that ease greatly as far as the availability of goods and supply chain and, sort of us getting back to somewhat we might consider normal, there's been some things in the news that, again, cause some concern here. This is from Reuters a few weeks back that shipping firms were avoiding the Suez Canal as Red Sea attacks increased. That has not eased up. I was looking through Reuters again. Global shipping firms continue to pause Red Sea shipping. Without going through the Suez, that is a massive increase in the price of your shipping, causes delays. How big of an impact that's really going to have, I don't know. So that's been the whole debate for higher for longer. And, well, how do we know? What do we see is going to happen? We don't know the future. Nobody can predict the future. However, I'm watching news like this. I'm watching crude oil terms react very, very strongly to interest rates and news on interest rates. And I'm watching interest rates themselves. So we head lower here in the last week. It's just these are the many pieces that we sort of look at and evaluate. Okay, I just wanted to say that for this week is that no, we're not looking at trading U.S. Treasury instruments and derivatives specifically. No, we're not looking at trading SOFR instruments specifically. Boy, the Chatham Financial puts this out, and it's just fantastic because it overlays the dot plots, and you can see where you're at on various terms. But we're not trading that specifically. What we are doing is keeping an eye on it because when it comes to inflation expectations, as well as I just don't see how they're going to get to these cheap rates. You got to look at the interest rate curves is what I'm saying, and the interest rate products. I just don't see how they're going to get away with it. Let's just say, for the sake of example, we arrive at this soft landing. Let's just say that's great. The economy's doing wonderful. Everything's growing. Everything's back on track. And you will hear from this crowd out there, it's like, yay, it's getting back to cutting interest rates. What are you talking about? You don't do that with an economy that's growing and doing wonderful. Like, I don't know. It just seems like people have like this Tourette's of just cut rates, cut rates, cut rates. It's like, you don't do that in a growing economy. Why do you think, what was that, 4, 5, 6 years ago, we were talking about raising interest rates for the very first time away from ZIRP, right? Why? Because the economy was doing so well. So when it comes to higher for longer, it's not just really bad inflation as to why, horrendous inflation like we've experienced, and maybe a repeat of 1977 to 1981. It's not just that. Let's just say, for the sake of argument, you get a soft landing, the economy grows. Guess what? That's what you're doing in that place. You got to have higher interest rates. I mean, that's sort of the part that I didn't include here is, economic forces, fiscal policy, monetary policy. That's not included in this very simplistic view here, but that's just, again, the review of inflation when it comes to those factors. Regardless, I've said that a number of times. So I don't think we're out of the woods yet. I don't think we're going to cheap rates. I mean, there may be cuts, but the Fed just recently put sort of the kibosh on that thought, right? Like, they had mentioned it briefly that we might see them, and the market just went absolutely histrionic nuts. And then they put the kibosh on that again from last week, right? Like, okay, great, wonderful. What if the economy starts doing well? Well, guess what? You don't lower the Fed fund target in that case. Not at all. So this is why we watch interest rates so heavily, even if you're only trading equities. And I don't even understand why people are in such a hurry to get to cheap interest rates. An economy can stabilize and do very, very well with higher interest rates. My very first car note, right? I was a young person, like 20 years old, got a brand new car. Dad co-signed for it. So check out this interest rate. I got an interest rate, and I can't remember it exactly, but it was around 7%. And all of my peers are saying, how did you get a car note that cheap? Like, that's impossible. Right? And I'm sort of styling, smiling, and profiling. That's right. I got that car note for around 7%, right? Because dad helped me out and dad co-signed for me. My point being is that, that would not be considered a good rate today. It was then. We can stabilize and sort of hit some sort of normalization with rates where you can live with higher interest rates and be doing very, very well. So, I mean, look at interest rates from what? 1941 to 1981, right? And by the way, the 60-40 worked from 1941 to 1981. The transition periods are horrendous, but that does work. So anyways, That's just been our thoughts. Why we include those curves, why we watch interest rates so heavily, even if we're just trading equities and equity products to know what's going on. But that has been what it's always been. That's simply been our thoughts, not yours, for whatever that date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.